The richest country on earth can still look strong while millions of people quietly feel broke. That is the strange part of America's consumer economy right now. Stores are still busy, restaurants still have lines, online carts are still moving. But under the surface, the signals are getting harder to ignore. More debt, weaker savings, higher living costs, nervous shoppers, and businesses trying to squeeze more dollars from people who already feel squeezed. This video breaks down 15 warning signs using plain English and real economic signals, so viewers can understand what is happening, spot the tricks, and make smarter choices before the pressure gets worse. The 15th warning sign is that spending still looks strong, but some of that strength is fake. When people hear that retail sales are rising, they often think shoppers are doing great. That sounds logical. More spending must mean more money, right? Not always. If prices rise, the dollar amount of spending can rise even when people are buying less. That is one of the most misunderstood parts of the consumer economy. A grocery bill can jump even if the cart is smaller. A restaurant tab can rise even if the family orders fewer extras. A clothing receipt can look larger even if the customer bought fewer items. The official retail sales numbers are reported in dollars, not automatically adjusted for inflation. So when sales go up, part of that can simply mean people are paying higher prices for the same basic life. This is why the consumer economy can look healthy from far away and stressed up close. In March 2026, official retail and food service sales were higher than a month earlier and higher than the same month a year before. On paper, that sounds like strength, but prices were also higher. The Consumer Price Index was up 3.3% over the year in March 2026, and energy, gasoline, food away from home, hospital services, car repair, and airfare all showed pressure. That means consumers were not just choosing to spend more for fun. Many were being forced to spend more to stay in the same place. And that is the hidden problem. A strong consumer economy is not just people swiping cards. It is people buying more because they feel secure. It is people replacing worn-out items without panic. It is people saving while spending. It is people choosing upgrades because they can afford them, not because the cheaper version disappeared. When spending rises because prices rise, that is not a celebration. That is a warning flare dressed up as growth. The 14th warning sign is that wages are rising, but the raise often disappears before people feel it. A worker can get a raise and still feel poorer. That sounds unfair, but it is common when living costs move at nearly the same speed as pay. In March 2026, real average hourly earnings, meaning wages adjusted for inflation, were up only slightly from a year earlier. That tells us something important. Many workers were not falling off a cliff, but they were not getting real breathing room either. The everyday version is simple. Your paycheck might be bigger than it was last year, but rent is higher, food is higher, insurance is higher, repairs are higher, and basic services cost more. So the raise lands, and then it vanishes. People do not experience the economy through charts. They experience it at checkout, at the gas pump, when the renewal notice arrives, when the doctor bill shows up, and when the car makes a strange noise. This is why many people are angry when economists say the economy is fine. Technically, some indicators can be fine. Jobs can exist. Spending can continue. Gross domestic product can grow. But if real wages barely move, the worker feels stuck. That frustration is not imaginary. It is the difference between nominal money and real money. Nominal money is the number printed on the paycheck. Real money is what that paycheck can actually buy. The controversial part is this. Some businesses benefit when consumers are confused by nominal increases. A company can say wages are up, sales are up, and demand is steady. But the household may know the truth faster than the spreadsheet does. The household sees that the raise did not create freedom. It only delayed the next problem. The 13th warning sign is that savings are thin, and thin savings turn small problems into expensive problems. The personal saving rate was around the low single digits in early 2026, with March reported at 3.6% of disposable income. That does not mean every household saves that exact amount. Some save a lot. Some save nothing. Some are draining savings. But as a national signal, a low saving rate tells us many people do not have much margin after taxes and spending. Margin is the difference between a normal month and a crisis month. It is what lets a person handle a flat tire without a credit card spiral. It is what lets a family replace a broken appliance without borrowing. It is what lets someone leave a bad job without immediate financial danger. When savings are low, every surprise becomes a negotiation with debt. The Federal Reserve's household well-being research has shown for years that a large share of adults would not cover even a modest emergency purely with cash or the equivalent. That matters because emergencies are not rare. Cars break, kids get sick, hours get cut, rent renewals jump, insurance premiums change. A low savings economy is like a bridge with no shock absorbers. It might stand during normal traffic, but one hard hit causes damage. Here is the part people miss. Low savings does not always look like poverty. It can look like normal life. A decent apartment, a working car, a phone, groceries in the fridge. But underneath, the household may be one bill away from borrowing. That is why the consumer economy can look polished and fragile at the same time. The 12th warning sign is that credit cards have become a survival tool, not just a convenience tool. In a healthy household, a credit card is a payment method. You use it, pay it off, collect points, and move on. In a stressed household, a credit card becomes a bridge between income and reality. The card pays for groceries this week, gas next week, a medical bill next month, and then the balance stays. That is where the danger begins. Consumer credit was still growing in early 2026. Revolving credit, which includes credit cards, was not exploding in the latest monthly data, but the total pile remained large. The New York Fed's household debt data showed credit card balances around the $1 trillion range at the end of 2025, and total household debt was in the many trillions. This is not the same as saying every household is in trouble. Many people use cards wisely. Many pay on time. But the warning sign is the direction and the role. Credit cards are expensive debt. They are not designed to be long-term grocery loans. When people carry balances because basics cost too much, the card becomes a private tax on being short of cash. There is also a quiet trick here. Minimum payments make debt feel manageable while keeping the balance alive. The payment is small enough to keep you in the game, but not always large enough to get you out quickly. That is the business model. The controversial truth is that some parts of the financial system do not need you to go broke. They just need you to stay slightly behind for a long time. The 11th warning sign is that delinquencies are no longer just a distant problem. A delinquency means somebody is late. Not annoyed. Not budgeting carefully. Late. The New York Fed reported that by the end of December 2025, 4.8% of outstanding household debt was in some stage of delinquency, up from the previous quarter. Serious delinquency transitions had ticked up for credit card balances, mortgages, and student loans. That matters because delinquency is not the first symptom. It is usually a later symptom. Before someone misses a payment, they often cut back, juggle due dates, borrow from family, skip repairs, delay medical care, use savings, pay one card with another, or work extra hours. By the time the payment is late, the stress has often been building for months. The tricky thing is that national delinquency rates can still look manageable while hardship is rising among specific groups. Younger borrowers, lower-income households, renters, recent homebuyers, and people with variable expenses can feel pressure first. A national average can hide pain because stable households pull the average down. That is why the economy can look okay in aggregate while certain families feel like the floor is moving. This is where the debate gets uncomfortable. People like to moralize debt. They say people should have planned better. Sometimes that is true. Bad choices exist. But it is also true that a system built on high housing costs, high medical costs, high vehicle costs, and high interest rates creates debt traps even for careful people. The question is not whether every borrower is innocent. The question is why being ordinary has become so expensive. The 10th warning sign is that restaurants and small luxuries are becoming pressure points. Food away from home was up more than overall food at home over the year in March 2026. Full-service meals were up more than limited-service meals. This matters because dining out is one of the first places consumers show stress without fully disappearing. They do not always stop going. They trade down. They skip drinks. They split meals. They choose pickup instead of delivery. They go less often. They avoid dessert. They tip with guilt and frustration at the same time. Restaurants are also trapped. They face labor costs, rent, insurance, card processing fees, food costs, delivery app fees, and utilities. So when the customer complains about the bill, the owner may also be squeezed. That is why the restaurant economy is such a clean window into consumer stress. Everyone can be telling the truth at once. The customer is paying too much. The worker needs better pay. The owner's costs are rising. The landlord wants rent. The delivery platform takes a cut. The card network takes a fee. By the time the meal lands on the table, 6 different cost pressures are sitting inside the price. Then there is tipping. Tip prompts have moved into places where tipping used to feel optional or unusual. A screen flips around. The lowest option can feel high. The customer feels judged. The worker may rely on tips. The business gets to keep menu prices looking lower than the true social cost of the transaction. That is not just a cultural annoyance. It is a sign that the consumer economy is shifting more burden onto the final moment of payment. When a normal sandwich starts to feel like a financial decision, something has changed. Not because people are entitled to cheap food forever, but because everyday convenience has become a luxury in disguise. The 9th warning sign is that shrinkflation and quality cuts are teaching people not to trust the shelf. Shrinkflation is when the package gets smaller while the price stays the same or rises. But there is another version that people feel even when they cannot prove it. The product seems thinner, the fabric feels cheaper, the snack bag has more air, the hotel breakfast is weaker, the customer service line is longer, the return window is tighter, the warranty has more exclusions. The economy is not only raising prices, it is quietly lowering what the price includes. This is one reason consumers feel more irritated than the inflation number suggests. Inflation measures prices in a structured way. It can track a lot, but it cannot perfectly capture every small downgrade in daily life. A cheaper zipper, a smaller portion, a thinner towel, a less helpful service desk, or a fee that used to be included can make people feel robbed, even when the official category does not scream crisis. Businesses do this because raising the sticker price is obvious, reducing size or service is less obvious. A customer remembers the price, but not always the weight. A customer remembers the monthly fee, but not always the features removed. This is why the package design changes slightly. This is why wording gets softer. New look can sometimes mean less for you. Not always, but often enough that consumers have become suspicious. The controversial point is that consumer trust is part of the economy too. When people believe every company is trying to trick them, they become defensive. They delay purchases, they search more, they complain more, they switch brands, they buy only on sale. That slows the emotional engine of consumption. A struggling consumer economy is not just broke wallets, it is broken trust. The 8th warning sign is that housing costs remain the giant weight on the household budget. Rent growth has cooled in many places, and that is real. Some rental markets have more supply. Some landlords are offering concessions like a free month or waived fees. But cooling rent growth does not mean rent is cheap. It means the pain is rising more slowly. In March 2026, national asking rent data from private market trackers showed typical rents still far above pre-pandemic levels, even though annual rent growth had slowed. This is where people get confused. If rent inflation slows, headlines may sound positive. But a renter does not pay the inflation rate. A renter pays the rent level. If rent jumped for years and then rises slowly, the household is still living with the damage from the earlier jump. Slower growth is not the same as affordability. Home ownership is not an easy escape either. Mortgage rates have remained high compared with the ultra-low rate years, and home prices in many markets are still difficult for first-time buyers. Even homeowners with fixed mortgages are not fully safe because property taxes, insurance, maintenance, and homeowners association fees can rise. Housing is not one bill. It is a stack. The most important thing to understand is that housing controls the rest of the consumer economy. If rent eats too much income, people cut restaurants, clothes, travel, hobbies, savings, and repairs. If the mortgage payment is too high, everything else becomes negotiable. Housing is the first domino. When that domino is heavy, the rest of the economy moves slower. The seventh warning sign is that cars have become a financial trap for many households. In much of America, a car is not a luxury. It is how you get to work, school, the grocery store, the doctor, and family. That gives the auto industry and the repair ecosystem enormous power over household budgets. Vehicle prices rose sharply during the pandemic period. Financing became more expensive as rates rose, insurance surged in many earlier years, and repair costs remained painful. By March 2026, the consumer price data still showed motor vehicle maintenance and repair up more than 6% from a year earlier. This matters because car trouble is one of the fastest ways a working household falls behind. A person may not have the cash for a repair, but they also cannot skip the repair because they need the car to earn income. So they use a credit card, take a loan, delay another bill, or drive an unsafe vehicle. That is not a normal consumer choice. That is economic pressure. Auto loans also stretch budgets because longer loan terms can make monthly payments look manageable while keeping people in debt longer. The monthly payment becomes the product. Dealers and lenders know many customers shop by payment, not total cost. That is why a buyer can feel like they got a deal while agreeing to years of payments, interest, insurance, and maintenance. Here is the uncomfortable truth. A society built around driving has turned transportation into a gatekeeper for employment. If the cost of keeping a car on the road rises faster than pay, the consumer economy weakens from the bottom up. People cannot spend freely when the car in the driveway feels like a financial hostage. The sixth warning sign is that consumers are being trained to accept fees as normal. Fees are everywhere. Service fees, processing fees, convenience fees, resort fees, delivery fees, activation fees, cancellation fees, late fees, restocking fees, paper statement fees, ticket fees, platform fees. The price you see is no longer always the price you pay. That is not just annoying. It changes behavior. Fees are powerful because they split the pain into pieces. A company can advertise a lower base price, then add the real cost later. By the time the customer sees the full total, they may be too tired, too busy, or too committed to walk away. Economists call some of this drip pricing. Everyday people call it getting nickel and dimed, except the nickels have turned into dollars. This is one of the clearest signs that the consumer economy is strained. When companies believe customers are price-sensitive, they avoid raising the headline price too much. Instead, they move charges into add-ons. The base product stays attractive. The final bill does the damage. There is a psychological trick here. People compare the first price they see, not always the last price they pay. A hotel room, a delivery order, a concert ticket, a rental car, or even a basic online purchase can feel affordable until the final screen. That final screen is where the modern economy collects its hidden toll. The controversy is simple. Companies will say fees reflect real costs. Sometimes they do. But consumers are right to ask why so many real costs are hidden until the end. A healthy market is clear. A stressed market becomes a maze. The fifth warning sign is that subscriptions are quietly draining households. A subscription can be useful, it can save time, it can spread costs, it can make life easier. But subscription overload is different. That is when every service wants a monthly bite from your bank account. Streaming, cloud storage, apps, software, meal plans, fitness platforms, delivery memberships, premium tiers, children's games, news, security tools, and product refills all compete for the same paycheck. The danger is not one subscription. The danger is forgetting the total. 10 small charges can feel smaller than one large bill, but the bank account does not care how the money leaves. Businesses understand this. Recurring revenue is prized because it is predictable. Investors like it. Companies like it. Consumers often underestimate it. There is also a design problem. Signing up is usually easier than canceling. The join button is bright. The cancel path can be hidden behind menus, confirmations, offers, and guilt screens. Some companies improve this. Others still rely on friction. Every extra click is a chance the customer gives up and keeps paying. This matters for the consumer economy because subscriptions make spending less visible. In the old economy, you decided to buy something each time. In the subscription economy, the decision repeats automatically until you stop it. That flips the burden. The company does not have to win your purchase every month. You have to remember to fire the company. When households are flush, that waste is annoying. When households are tight, it is dangerous. A struggling consumer economy is full of people paying for things they barely use because cancellation is inconvenient and life is busy. The fourth warning sign is that buy now, pay later has moved from occasional splurge to everyday finance. The idea sounds harmless. Split a purchase into 4 payments. No interest if paid on time. Smooth the budget. For disciplined consumers, it can be fine. But the risk is that it makes the real cost feel smaller at the exact moment the customer should be thinking clearly. The Consumer Financial Protection Bureau has reported that buy now, pay later usage expanded over the past several years. Federal Reserve research has also noted that the market has grown quickly, though its direct threat to financial stability appears limited for now. That last part matters. This is not a claim that buy now, pay later is crashing the economy. The warning is more subtle. It changes how people feel prices. A $40 purchase split into 4 payments does not feel like $40. A $200 cart split into installments does not feel like $200. The payment feels tiny, so the decision feels safer. But multiple tiny payments across multiple apps can pile up. The consumer may not see one big debt balance. They see scattered promises. This is a new kind of financial fog. Traditional credit cards show a balance in one place. Installment products can spread obligations across platforms, dates, and merchants. That makes budgeting harder. And when people use installment plans for essentials, not just luxuries, the signal gets louder. It means income timing and living costs are no longer matching. The controversial truth is that affordability tools can become affordability masks. They do not always make things cheaper. They can simply make expensive things feel temporarily painless. The third warning sign is that consumer confidence is shaky even when people keep spending. This is one of the strangest parts of the current economy. People can feel bad and still spend. They can distrust the future and still buy groceries, fix the car, attend a wedding, replace a phone, or take a short trip. Spending is not always optimism. Sometimes spending is obligation. Consumer sentiment readings in early 2026 showed deep concern about inflation expectations. One major survey showed year-ahead inflation expectations rising in April 2026 from the prior month, with longer-run expectations also moving higher. That matters because expectations can become behavior. If people believe prices will rise, they may buy sooner, demand higher wages, avoid long commitments, or become more cautious with savings. Confidence is not just a mood. It is fuel. When people trust the future, they make bigger plans. They move. They upgrade. They start businesses. They buy homes. They have children. They take career risks. When confidence weakens, people may still spend, but they spend defensively. They look for deals. They delay big purchases. They keep old items longer. They become harder to impress. This is why low confidence can be controversial. Some analysts dismiss it because spending continues. But that misses the point. A person can keep walking with a stone in their shoe. The walking does not prove the shoe is comfortable. It only proves the person has somewhere to go. The second warning sign is that small businesses are feeling the squeeze from both sides. Small businesses sit between suppliers and consumers. When costs rise, suppliers demand more. When customers are stressed, they resist price hikes. That leaves the business owner trapped in the middle. Raise prices too much and customers leave. Keep prices too low and margins vanish. The National Federation of Independent Business reported that small business optimism fell in March 2026 and sat below its long-run average. Its uncertainty index was also elevated. That is not just a business owner mood swing. Small businesses are where consumer weakness often shows up early. If people skip services, delay repairs, reduce tips, buy fewer extras, or trade down, local businesses feel it quickly. A large corporation can absorb pressure, automate, renegotiate contracts, or use scale. A small business may not have that cushion. The owner sees the slowdown in real time. Fewer appointments, smaller baskets, more price complaints. More customers asking, "Is that the best you can do?" More people waiting until payday. The controversial part is that the public often blames small businesses for high prices while ignoring the costs behind them. But small businesses also sometimes use inflation as cover to raise prices more than needed. Both can be true. The consumer economy is strained because everyone is trying to protect themselves at once. Suppliers protect margins. Owners protect survival. Workers protect wages. Customers protect budgets. That creates a tense economy, not a confident one. The first warning sign is that the whole economy depends too much on consumers who are already tired. Personal consumption expenditures made up about 68% of gross domestic product in the first quarter of 2026. That means consumer spending is not a side story. It is the main engine. When the American consumer slows down, the whole machine feels it. The Bureau of Economic Analysis reported that real gross domestic product grew at an annual rate of 2% in the first quarter of 2026, faster than the weak fourth quarter of 2025. But the same report said the acceleration was partly offset by a deceleration in consumer spending. That is the key. The economy can grow while the consumer weakens. Investment, exports, government spending, and inventories can help the headline. But if households are strained, the foundation is less stable. This is the biggest warning sign because it connects all the others. Higher prices reduce real buying power. Thin savings reduce resilience. Credit card balances add interest. Delinquencies reveal stress. Housing eats budgets. Cars become traps. Fees hide true costs. Subscriptions leak money. Installment plans blur debt. Confidence falls. Small businesses feel it. And still, the economy asks the consumer to keep going. That is why the phrase resilient consumer can be misleading. Resilient can mean strong. It can also mean exhausted but still standing. A family that keeps spending by using credit, skipping savings, delaying repairs, and cutting quality of life is not thriving. It is absorbing shock. So here is the tight recap. America's consumer economy is not collapsing in one dramatic scene. It is struggling in smaller, quieter ways. People are spending, but often because prices are higher. Wages are rising, but not enough to create real comfort for everyone. Savings are thin. Credit is doing too much work. Late payments are creeping higher. Housing and transportation are still heavy burdens. Fees, subscriptions, shrinkflation, and installment plans are making the true cost of life harder to see. Confidence is weak, and small businesses are caught between rising costs and tired customers. The lesson is not to panic. The lesson is to pay attention. Watch the final price, not the advertised price. Watch the monthly total, not the single payment. Watch your savings, not just your income. Watch whether a purchase solves a real need or just delays stress. And most of all, watch the gap between what the economy looks like on paper and what it feels like in real life. If this helped you see the consumer economy more clearly, like the video, share it with someone who keeps saying, "Why does everything feel so expensive?" And comment with this question: which warning sign are you seeing most in your own life right now?